Hey, what's going on everyone? Welcome to another video. Quick reminder, if you could like and subscribe, that'd be amazing. This is a newer channel, so all the engagement would be much appreciated. With your engagement, I hope to make the content better and better. And from there, let's jump into the video. So today I want to walk through two options that you can do on Dividend Aristocrats. The two companies I'm going to walk through are Dividend Aristocrats, and you may be asking, what does that mean? That means they've increased their dividend for at least 25 consecutive years. Dividend Aristocrats are great to do this option strategy on because they're a little bit safer companies, stable income statement, stable cash flow, and so on. And they've consistently increased their dividend, meaning they're able to pay their investors year after year after year. So the two I'm going to talk about today are Walmart and 3M. So looking at 3M, you can see here they've consecutively grown their dividend 64 years. That's incredible. Jumping down to Walmart, you can see that they've increased their dividend for the past 49 years, which is unbelievable. So quickly jumping in, I want to talk about Walmart first. So here's Yahoo Finance for Walmart. And as a quick reminder, Walmart was founded in 1962, and today they currently have 2.3 million employees. That includes all the retail employees, so therefore it's a much larger number. Their market cap is hovering around $400 billion, earnings per share $5, and a PE ratio of 29. According to Yahoo Finance, 1-year target estimate is 152, so a little bit of room to go. And you can see here the forward dividend and yield is $2.24, which is 1.62%. So looking at the chart real quick, you can kind of see it's been trending upward. Yesterday, earnings came out recently, therefore it was a massive jump after they reported earnings. So even with that coming out, I still think this option strategy that I'm going to dive into could be beneficial to utilize on Walmart. So going over here to Yahoo Finance chart, you can see Walmart's been consistently increasing over the past couple of months after they dipped pretty heavily down here. In that time frame, that was about end of May. And then with this recent peak after earnings, you'll see that there's a massive jump here. So the key question I think about is, okay, Walmart's jumped significantly after this earnings report. Yes, I agree there could be potential growth to the stock, but when thinking about the option strategy I'm going to walk through, I still think Walmart could be a good play for this. Now I'm going to quickly walk through the option strategy you can do on Walmart. And quick reminder, there's a link to Option Strat in the section below, so feel free to grab that link, sign up for Option Strat. I'll benefit and you'll benefit from accessing this amazing tool. So you're going to want to go ahead and click Build. And the strategy we're going to talk about today is a bear call spread. So in this strategy, you're effectively selling a call and buying a call at different strike prices but on the same date. So the max risk is going to be the delta between the two strike prices. So in this example, I'll walk through Walmart. So let's say we go with December 16th, and I'm going to bump this up to 160 and this one to 155 just for right now. So what this option chain is saying, and this strategy is saying, is I'm effectively selling a 155 call, but I'm protecting myself by buying a 160 call at the same time on the same expiration date. So what that means is the max margin that you're effectively putting up, or the amount of money that you're effectively putting up for this strategy, is the delta between these two strike prices. So in this example, it's only $500. And in this example, you will get a net credit of $64. So that means you'd be getting over a 10% return in these 31 days. Now you may be thinking, oh, Walmart's going to continue to rise, which is totally fine. It can continue, but this elevated jump may mean it could be a good time to start doing this option on Walmart. So if you want to be a little bit more conservative, you could push these strikes out. Here you'll see it's definitely not as good of a ROI on the margin you're putting up. It's $20 for putting up $500, excuse me. But it's up to you depending on the level of risk and how much you're willing to put up for the option and how much you're looking to get back. If you jump down to 150 and 155 and you change it to the end of the week this week, See, it's a 10% return, but in my opinion, this is way too close to expiration, and the stock price could continue to go up. So I personally would select strike prices a little bit further out and about a month out. Um, as you can see here, you can see how much of this option income premium you'll be keeping depending on where the stock price lands at expiration. So if the stock continues to rise but it stays below 155 at the end of the day, you'll collect that $64. You'll keep that $64 because that's already in your account, but the option will expire worthless. So this is one example I wanted to share on Walmart. Now, the second company I want to talk about is 3M. So jumping over here, quick overview of 3M. They're a multinational conglomerate operating in the field industry, worker safety equipment, US healthcare, and consumer goods. They have over 60,000 products and were founded in 1902. So they are over 100 years old. They have tons of products across tons of different areas. So it just shows how big they are and how widespread their product are. So the market cap is definitely much smaller than Walmart when looking at 3M. So here they're only 72.5 billion. Earnings per share are higher, they're $11, and the PE ratio is almost exact same, 11.45. So very similar PE and earnings per share. And one thing that excites me about this dividend stock is the forward dividend is $5.96, which is a 4.55%. There has been some news recently about 3M and a lawsuit regarding some of their products, so those are definitely things to keep in mind when doing the strategy, which also could be another reason to consider the strategy for 3M, as that may impact the stock price from increasing significantly and may keep it at a little bit of a more of a neutral position. As you can see in the 6-month view, it has somewhat been trending down with a recent pop. I think this recent increase could be a good opportunity to exercise a call credit spread on 3M. So now I'm going to jump over back to option strat for 3M, and I'll do the same exercise. I'll do a bear call spread here, and I'll walk through this for 3M. So over here, you're going to type in 3M. We'll let it load. And then now I'm going to do the same thing. I'm going to select December 16th, and I'm going to adjust the strike prices for this trade. So stock price is $131. I'm going to go out to 145 and I'm going to go out to 140 to show you what this looks like. So if you were to sell a call at 140 and then buy a call at 145, so you're effectively protecting yourself from any mass increase in the stock price, you would get a net credit of $42. I know you may be thinking $42 is not that much, but in the grand scheme, that's almost an 8.5% return in 31 days. If you want to be a little bit more conservative and you're worried about the stock price creeping up, you could adjust the strike prices here where you're still risking $500 because of the spread between 150 and 145. You're only getting a $15 return. In my opinion, the risk and reward may not be as great here. It's only 3%. Annualized, it is 36%, but it's just not that good of an ROI from an options point of view, in my opinion. Playing with the dates here, or some of the other option strike prices, if you want to be a little bit riskier and say, 130 and 135, which is currently trading, and you're super bearish on the stock going down even more, then this is something you could do. Here you would get a net credit of $216, and you'd have to effectively be putting up $500 to do this option strategy. And that, from a percent standpoint, would be a 43% return. That's great, but just keep in mind that these option strategies won't always go in your favor. So just a couple things to keep in mind when you're looking to sell and do these types of option trades. Quick note, the implied volatility here is 20%. This is definitely lower, but I think that's expected given it's a Dividend Aristocrat. So keep that in mind. In my opinion, I think these could be good option strategies to try out on 3M. Again, you're risking much less capital up front, only $500 to do this bear call spread. Whereas if you were to sell a put, you'd have to, put up effectively in this scenario, if you were selling a 130 call, $13,000. So a couple things to keep in mind, when trying to look at option strategies, and depends on how big or how small your portfolio is to play with. So that's it for today's video. Thanks for listening in. Hope you guys appreciated it. Please like and subscribe to help the channel out. Much appreciated. Feel free to access the option strat link below in the description. Hope you have a great day, and we'll talk to you soon.